The Australian dollar is approaching a critical liquidity zone and, well, smart money is already positioning for the next major expansion. Welcome to this explainer. Today, we're stepping far away from the noise of retail trading. We're looking at the AUD/USD market strictly through the lens of institutional order flow. So if you want to understand exactly how market makers are positioning themselves using smart money concepts and liquidity analysis, you're definitely in the right place. Let's dive in. Right now, we're looking at a highly complex market environment. You see, global tensions and pending macroeconomic data are converging right now, and they're forging a massive liquidity trap for retail traders in the AUD/USD market. Impending volatility is right on the horizon, and smart money is already engineering the liquidity needed to fuel the next major expansion. To understand the precise mechanics of how this trap is being laid out for us, we first need to evaluate the fundamental vectors driving the broader market. Just take a look at the sheer momentum of the US dollar index, or the DXY. It's pushing right above that 99.00 level. And this is entirely driven by a sudden surge in safe haven demand. We've recently seen US self-defense strikes in southern Iran, targeting missile sites and vessels that were attempting to deploy naval mines. Now, while reports do indicate that talks to end the conflict are actually progressing, Iranian officials have been pretty clear that a deal is not imminent. This lingering geopolitical uncertainty is heavily boosting safe haven assets like the greenback, which of course creates an immediate headwind for risk-sensitive pairs like the Aussie dollar. The absolutely crucial point here is that technicals never exist in a vacuum, right? They're fueled by these macro catalysts. Alongside that geopolitical risk driving US dollar safe haven flows, we are staring down the barrel of some pivotal economic data. Australian CPI data is expected to show headline inflation cooling to 4.4% year-over-year in April. That's down from 4.6%. Any deviation here is going to spark immediate volatility. Plus, the market is currently pricing in a 41% probability of a 25 basis point rate hike by the Federal Reserve by the end of the year. That keeps the dollar fundamentally supported. This specific combination of geopolitical tension and central bank divergence provides the exact catalyst institutional order flow requires to manipulate price. Okay, let's transition to the higher timeframe bias so we can actually observe how this fundamental backdrop translates to price action. Looking at the H4 timeframe, the overarching structure is currently sideways to slightly bullish. After a previous sharp decline, the price has basically established a bottom and is recovering. It's holding nicely above both the 50 and 100 exponential moving averages. Now, at first glance, this structure suggests that buyers are attempting to regain long-term control. But remember, institutional logic requires us to look a lot deeper than just the surface trend. Zooming into the H1 timeframe, the retail buying trend looks, well, clear and obvious. We see a bullish structure forming higher highs and higher lows, with price tracking cleanly above the moving averages. This is exactly the type of structure that induces late retail buying. But here is the critical institutional warning sign. Look at the MACD indicator down at the bottom. Notice how price is making higher highs, but the MACD histogram is actually printing lower highs and shifting red. That right there is a clear bearish divergence. Upward momentum is completely exhausted. Furthermore, the average true range, or ATR, is sitting very low at just 5.8 pips. The market is compressing, which tells us a violent expansion is practically imminent. Now, before we drop to the execution time frame, we really need to define the exact parameters we're looking for here: a liquidity sweep and a change of character, or CO choke. This happens when smart money deliberately forces price past a key high or low. The objective? To trigger clusters of retail stop losses. This provides the massive liquidity the institutions absolutely need to fill their own opposing orders. Once those stops are hit and the liquidity is absorbed, they abruptly reverse the trend, leaving late buyers totally trapped on the wrong side of the market. Understanding this is absolutely vital, as it's the foundational blueprint of institutional liquidity engineering. So let's look at how this plays out. This M15 timeframe effectively demonstrates that exact blueprint in action. Notice the deliberate, sharp push up right into the 0.7175 zone. This was a highly targeted move to sweep the buy-side liquidity, essentially triggering the stop losses of early short sellers. Immediately after that, price fails to hold that level, aggressively rejects, and drops straight through the 50 and 100 EMAs. That structural break, that's our bearish change of character. The RSIs also plummeted down to near 39, confirming the sudden aggressive shift in short-term momentum from bullish to bearish. To truly grasp what's happening, consider the market as an auction mechanism. Retail traders, they analyze the H1 chart, see price above the moving averages, and they buy late at the top, entering at a premium price. They then place their stop losses clustered safely, or, so they assume, just below the recent lows. But smart money operates with the exact opposite logic. They actually engineered that upward move to induce retail buyers at premium prices, solely to acquire the liquidity they needed to aggressively sell off and drive the price down into a discount zone. Why? Just to hunt those very stop losses. And we don't just guess here, we require strict technical confluence to prove this is an actual institutional move. First off, the M15 chart printed a clear bearish engulfing structure right after sweeping those highs. Second, and this is absolutely crucial, observe the volume profile. We see sudden heavy volume spikes, specifically on those downward red candles, right as price broke the moving averages. This indicates deliberate active distribution by deep-pocketed players. It's not just random market noise. Finally, the 0.7170 to 0.7175 zone is acting as an area of strong price rejection, which is clearly marked by multiple wicks on the higher timeframes.
So what does this all mean for us? How do we actually execute on this? Well, we align our positioning directly with the smart money manipulation. We have a high probability execution plan that involves two phases. Because the higher time frame remains technically bullish, but the short-term institutional order flow is aggressively bearish to hunt liquidity, we've got a short-term sell scenario to ride the manipulation downward. And then this is going to be followed by a long-term buy scenario to capture the actual fundamental market expansion once that manipulation phase is fully complete.
Let's break down the exact trade parameters. For the short-term sell, we're looking for a retracement entry right around 0.71650. Our stop loss is tight, set at 0.71770, resting just above that recent liquidity sweep. Our target is the sell-side liquidity pool at 0.71350, which provides a highly clinical 1 to 2.5 risk-to-reward ratio. Now, once price reaches that discount zone and sweeps that lower liquidity, we shift gears to our long-term buy scenario. We enter at the major demand zone of 0.71200 with a stop loss below the H4 structure at 0.70990, targeting a return all the way up to 0.71700. This offers a nice 1 to 2.3 risk to reward. Remember, strict risk parameters like this are the absolute foundation of institutional logic. Now, we have to do a critical assessment of market sentiment and risk factors. The short-term bears are firmly in control of the order flow at this very moment. However, we have major macroeconomic data pending. Specifically, US PCE and consumer confidence figures are dropping later today. This is going to inject extreme volatility into the market and could cause dramatic liquidity spikes in literally both directions. Strict capital preservation is paramount here. Also, keep in mind, this entire bearish setup is totally invalidated if we see a strong, high-volume candle close above the 0.7178 level. If that invalidation actually occurs, the institutional narrative has shifted and you must step aside. So, to summarize this technical breakdown, you really want to keep this definitive pro-trader narrative in your head. H1 shows bearish divergence, and the M15 prints a change of character after sweeping buy-side liquidity. Therefore, our immediate priority is to scale into short positions around 0.7165 to hunt the sell-side liquidity resting below at 0.7135. The key takeaway, do not be the liquidity, hunt the liquidity. Ultimately, this is the main difference between just reacting to the market and actually anticipating the market makers. You have to ask yourself, are you trading the pattern or are you trading the liquidity that the pattern creates? Really think about that before you allocate capital to your next position. If you want more institutional-style market analysis using smart money concepts and the ICT methodology, make sure you're subscribed. You can also open your trading account using the link in the pinned comment to follow future market breakdowns and trading opportunities. Stay disciplined, manage your risk, and I will see you in the next explainer.